All right, we have more changes unfolding in the U.S. economy and at a major financial institution. Changes that have more bad news for one of the oldest and most well-respected banks in the country, a bank with such a stellar reputation. It's hard to even imagine them being SVB'd. Well, we'll look at what just happened at Schwab because the rumor and the innuendo hasn't stopped. It's just been gathering up steam, and the recent news that quietly trickled out this past Friday seemed to go completely under the radar. So we're going to look at that as well as what may happen this coming Tuesday, a big day with potentially big consequences. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So Tuesday, folks. Tuesday's the big day when the next FOMC meeting takes place or begins. All of the members conjoin behind closed doors, deciding the fate of our economic policy. Well, here's what JP Morgan's forecasting the Fed's going to do. This note was sent out yesterday. It says this: we expect the FOMC will leave policy rates on hold next week, although we believe the post-meeting statement will likely leave intact the hawkish bias, referencing the extent of additional policy firming that may be appropriate. So JP Morgan says no more hikes, but to expect a hawkish tone. Well, we also have Morgan Stanley's forecast. Take a look at what they write. The FOMC remains on hold at 5.375%, which we see as the peak rate of the tightening cycle. We continue to expect it to be on extended hold before making the first 25 basis point cut in March of next year. So they're even more dovish, saying no more hikes, and they go on to actually say that they think the Fed's going to even scale back their hawkish tone, and they're forecasting the first cut is going to come in March of next year. What do you think? Let me know in the comments. Do you think the Fed is done, completely done, or if they'll hike at least one more time? So now we know what the two largest investment banks are telling their clients to expect for next week, but what about the most prescient Wall Street analyst, in my opinion, B of A's chief financial strategist, very smart guy. Well, 2 weeks ago, he wrote this in his Friday note: the price is right. U.S. jobs market softer. Job openings to unemployed ratio lowest since September 2021 equals strong tell that the Fed is done. We'll sell the last rate hike, he said. And we can see what he meant in this chart. Whenever the light blue line, U.S. job openings to unemployed ratio, begins falling, the Fed normally would have already began their pivot. Well, since then, what has happened? We saw headline CPI come in higher, lots of headlines, no pun intended, around CPI jumping last week, but the important metric, the inflation metric that the Fed actually cares about, core CPI, fell. They prefer to watch core because it strips out the volatile sectors, right? Now, he went on to highlight unemployment this past Friday again, writing this: the biggest picture, 417 days until U.S. election. It's the economy, stupid. So watch jobless claims in 7 most critical battleground states: Pennsylvania, Michigan, North Carolina, Georgia, Arizona, Wisconsin, Nevada. In Pennsylvania, claims still at a low of 13,000, but rising quickly from 7,000 back in July 2022. So we can see unemployment claims beginning to rise in Pennsylvania. And when this starts to happen, can easily get out of control as the Fed's tightening campaign has a lag effect, right? How big of a lag? There's no way to know. 550 basis points worth of rate hikes, though, it doesn't go bang, hit everyone the following day or 1 month later or even 6 months later. It's more nuanced than that. But once you start to see unemployment pick up, it usually happens quickly. And from revisions as well, here's what Hartnett explains how he sees this all playing out. He writes this: higher equals harder. We believe higher means harder. Respect the lags, stuff that monetary policy meant to impact starting to inflect higher. Inflections that normally occur as recessions begin normally lead to significant buying of bonds. Yield curve steeper, full year defaults up from 1.6 to 3%. Credit card delinquencies now up from 0.8% to 1.2%. Personal savings rate up from 3% to 4%, unemployment rate up from 3.4 to 3.8%, and mortgage applications at a 28-year low. Now, what he wrote ties into what's happening with Schwab. Inflections that normally occur as recessions begin normally lead to significant buying of bonds, he said. Well, let's see if that's happening, folks. What do you know? U.S. government treasuries on course for a record year with over $207 billion of inflows, even higher than the year of the Cove. But we should also see a run to money market funds. Do we see that happening as well? We most certainly do. We most certainly do. Money markets on course for a record $1.5 trillion year. Again, even higher than the year of the COVID. And this is where Schwab comes in, right? All of the rumor and speculation started following the banking crisis 6 months ago after a huge volume of their customers began moving their deposits out of their Schwab accounts and into money market accounts. Here's their CEO addressing this a few months ago on CNBC. Take a listen to this.
Rates start to move up, then we reach out to our clients and encourage them to move their longer term investment cash into a money market fund or a CD or treasury bills, whatever's in their best interest. And so they go ahead and take that action. We began that process over a year ago, so we're probably ahead of maybe some of the other organizations that they may be just entering into this world that you refer to as sorting. But we see it, again, we see the trajectory moderating. But it's a good thing, and I don't want to put it in the context of something negative. It's what clients should do and what we encourage them to do.
But also puts pressure on your profitability.
Well, it does in the short run, but at Schwab we play a much longer term approach than that.
So he's doing his job, right? Trying to mitigate the fallout there. But before we get into what just happened at Schwab this past week, the reason this is happening to them in the first place is because they are ultra sensitive to interest rate fluctuations, unlike most other banks. And they did the same thing that SVB happened to do. As did many others, before the Fed started hiking rates last year, they took their customer deposits and invested them in safe, long-dated fixed assets like mortgage-backed securities and long-dated treasury bonds, both of which had low rates at the time, unlike today. Give you an example. Schwab is earning 1.7% on hundreds of billions of dollars of mortgage-backed securities that they purchased. 1.7%, that's it. When if they were to buy those MBS today, they'd be earning 3 to 4 times that, which means that they made a bad decision last year. They bought all those fixed assets right before the Fed began their hiking campaign, thinking they were getting ahead of the Fed and taking the safe approach, but they ended up locking themselves up, stuck now only earning 1.7% yield, and they can't sell them because over the past year, investment grade bonds like treasuries and MBS have been falling in price and rates have been increasing. And that's the crux of the issue here. They are unable to offer you a higher interest rate on your Schwab account because they've locked themselves up. Now, last month, it was reported that they're going to start closing offices, right, and conducting these layoffs to cut costs. Well, that was last month. Fast forward to this past Friday, 2 days ago, Schwab released their monthly update. And everyone knows you put out bad news on a Friday, right? Well, this is from Barron's. The headline of the piece is Charles Schwab net new assets fall on TD Ameritrade attrition. The stock is down. They go on to write this. Most months, Charles Schwab rakes in lots of fresh client money, but in August, not so much. Schwab said on Friday that core net new assets only totaled $4.9 billion last month, down from $43 billion the same month a year earlier and $13.7 billion in July. The brokerage firm attributed the declines to the temporary attrition of TD Ameritrade clients and advisors. Look, the TD Ameritrade acquisition happened 3 years ago, by the way, and they keep seeming to use it as an excuse for these negative headlines. They say that the loss of these clients is coming from converting them over from TD Ameritrade to their Schwab platform. So either they're choosing to drop these clients for some reason, or clients are choosing to not transition over and just pull their money. I don't know about you, but if you ever had an account with a bank after they were acquired, it's usually pretty seamless, at least in my experience. I don't know, if it's the same thing with Schwab. I've had credit card processor accounts over the years who were bought out by other bigger processors, and all they did was just notify me of the new URL I would use to log in. So it seems a bit odd to me. It's still causing all these issues for them. Barron's goes on to write this. The company has been in the process of moving clients and advisors to its platform from TD Ameritrade, which it bought 3 years ago. Some advisors and retail investors who did not want to migrate to Schwab's platform likely bolted before Labor Day weekend, when Schwab was scheduled to move approximately $1.3 trillion in TD Ameritrade assets. Look, as unlikely as Schwab is to be SVB, it's still important to keep an eye on, right? They can definitely be considered too big to fail. So when you see a bank like Charles Schwab having issues like this, it's worth investigating. You don't see the same type of issues with JP Morgan or Bank of America. Schwab obviously is a bit different with their brokerage division, but they're still a bank, folks, and we've seen other giant banks crumble within days. So being we're in the later stage of this tightening campaign, keeping an eye on them and any other wobbly banks is the prudent thing to do, in my opinion at least. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.